Welcome to The Explainer. Today, we're going to completely shatter and then rebuild the way you look at your trading profits. Seriously, if you've been measuring your success by how many dollars you made or lost on any given day, you are literally flying blind. And worse, you're probably sabotaging your own progress without even realizing it. So today, we're breaking down the math of risk units. Make it simple, make it beginner friendly. By the end of this, you're going to have a completely new lens through which to view your strategy, your edge, and honestly, your entire trading career.
Okay, let's dive into this. Trader A made $3,200 last month. Trader B made $1,800. I want you to genuinely think about it for a second. Who had the better month? Your brain immediately screams Trader A, right? I mean, more money equals a better month. It seems incredibly simple. But as we're about to uncover, in the world of professional trading, raw dollars tell you almost nothing about actual skill.
So here is the agenda for how we'll unpack this puzzle today. Number 1, the dollar P&L illusion. 2, what R actually means. 3, win rate versus expectancy. 4, calculating the expectancy formula. And 5, prop firm minimum requirements. Section 1, the dollar P&L illusion. You know, looking at raw dollars is essentially like staring into a distorting funhouse mirror. It stretches and warps the reality of your trading edge. It makes bad habits look great and sometimes makes excellent trading look terrible. Let's add that missing context to our two traders. Remember how Trader A made more money? Well, let's look under the hood. Trader A was risking $2,000 on most of their winning trades, but only risking $500 on their losers. They were unconsciously and wildly varying their position size, sizing up when they won, sizing down when they lost. That great month is heavily reliant on pure luck and reckless sizing. But take a close look at Trader B. Trader B risked exactly $1,000 on every single trade. For every dollar they risked, they made $1.80 back. Their strategy is consistent, it's measurable, and it's genuinely profitable on a risk-adjusted basis. If both of these traders entered a prop firm challenge with strict drawdown limits, no joke, Trader A would blow up almost instantly, while Trader B would easily pass. I want this concept to permanently stick in your mind. Dollar P&L is mostly a measure of your position size. R multiples are a measure of your strategy. Think about it deeply for a second. If you have a small account and make $500, you might feel a bit disappointed. But if you only risked $200 per trade to get there, your strategy actually performed incredibly well. Conversely, making $3,000 sounds absolutely fantastic, but if you had to risk $2,500 per trade to get it, your strategy is barely treading water. Stripping away that dollar noise is literally the absolute only way to reveal your true underlying edge. Section 2. What R actually means. All right, we are about to learn the secret language of professional traders. First up is the letter R. R is simply the exact amount you risked on a given trade. It isn't some fixed number across your whole life. It changes with every single trade depending on your position size and where you place your stop loss. If you calculate your setup and decide to risk $1,000, then for that specific trade, your R is $1,000. I want you to visualize R as a solid 3D block representing your base risk for that exact specific setup. And once you have your R block, we arrive at the R multiple. This is just a number that tells you how many times you multiplied or fractioned that initial block of risk. This metric is a game changer because it cuts right through all of that P&L distortion we just talked about. It solely focuses on how a trade performed relative to its specific, unique risk. Let's look at a few examples. Take a scenario where your initial block, your risk, is $1,000. You take the trade and you make $2,000. That means you doubled your risk block. That's a 2R win. Awesome. Now imagine another trade. You risk $1,000 and make $1,500. That is a 1.5R win. Now let's talk about losses because they happen to all of us. A standard full loss happens when you risk $1,000, your stop hits, and you lose that $1,000. That goes down as a negative 1R loss. But consider a situation where you risk $1,000, but you exit early. Maybe you saw the market structure shift abruptly, and you only lose $600. Because you lost a fraction of your initial risk, that goes into your journal as a negative 0.6R loss. See how this works? It proves that R multiples precisely track exactly what happened on the chart, completely independent of whatever account size you happen to be trading at the time. Section 3. Win rate versus expectancy. Get ready because we're about to bust the single most common myth that traps beginner traders. You've probably heard this statement, or hey, maybe you've even said it yourself. My strategy has a 60% win rate. That means it's profitable. Well, actually, not necessarily. In fact, a high win rate can sometimes completely mask a devastatingly losing strategy. Picture this. Consider two completely different strategies. On one hand, you have a strategy winning 60% of the time. On the other hand, a strategy winning just 40% of the time, meaning it actually loses the majority of its trades. Your instinct is to immediately grab that 60% system, right? But that smaller 40% slice can actually hold substantially more value if your risk units are structured correctly. And this brilliantly illustrates exactly why that happens. Strategy A wins 60% of the time, sure, but the average winner is tiny, just 1.2 R, and the average loser is a full 1 R. Strategy B, on the other hand, only wins 40% of the time, but when it wins big, an average of 2.5 R. When we do the math, Strategy B actually makes more money per trade. Strategy B completely dismantles the illusion that a high win rate equals higher profits. Listen, win rate just tells you how often you're right. But what we really, truly care about is expectancy. Section 4. Calculating the expectancy formula.
Welcome to the ultimate metric. This is the holy grail of trading math. So, what exactly is expectancy? It's a metric that tells you whether being right when you are right is mathematically worth being wrong when you are wrong. Period. If win rate is just a vanity metric, expectancy is the ultimate truth teller of your entire trading system. It perfectly combines how often you win with exactly how much you win relative to your risk.
Here is the formula. Expectancy equals your win rate times your average R winner minus your loss rate times your average R loser. Okay, I know reading formulas can feel a bit like high school algebra, but I reassure you, plugging your numbers into this is so much simpler than it looks, and doing so will absolutely change everything. Let's actually guide you step by step through a real calculation right now. Step 1, find your win and loss rates. If out of 100 trades you won 45, your win rate is 0.45, which means your loss rate is 0.55. Step 2, average your R values. Let's say over those specific trades, your average winning trade was 2R, and your average losing trade was a standard 1R. Step 3, multiply the winners, multiply the losers, and subtract. So 0.45 times 2R gives us 0.90R. Then 0.55 times 1R gives us 0.55R. Finally, we subtract 0.55 from 0.90. And the result is a positive 0.35R. But what does this number actually mean for you in the real world? It means that for every single trade you take, whether that individual trade ends up winning or losing, the strategy statistically yields 0.35 times your initial risk amount on average over a large sample. If you are risking $1,000 a trade, this unbreakable math dictates you can expect to make $350 per trade over the long run. Say you take 30 trades a month, that's an average of $10,500. The math simply doesn't lie.
Section 5. Prop firm minimum requirements. Now, we need to transition into the practical application of this math, specifically for traders who are looking to pass funded challenges, where constraints are incredibly tight. Let's break down these crucial benchmarks. The absolute minimum acceptable expectancy to survive a prop firm is positive 0.25R. So the crucial point is, anything below this means your edge is dangerously thin. Why? Because normal variance, just everyday standard losing streaks, will eat right through your drawdown buffer before the math can even save you. A comfortable strategy sits between 0.35R and 0.50R, giving you plenty of breathing room. And a strong expectancy is anything above 0.50R. That is where the consistent, heavily funded traders usually land with their absolute best performing setups. But I must warn you right now, evaluating a strategy on under 50 trades is practically useless. Random variance is a very real thing in the markets. You could have a genuinely brilliant strategy that just happens to hit a terrible string of luck and shows negative expectancy over a small 20-trade sample. A real, back-tested, trustworthy edge requires a large sample size. 50 to 100 trades is the absolute minimum before you can truly trust these numbers with your capital. All right, to summarize your actionable takeaways, start tracking this today. Seriously, record what you risked in dollars, record what you made or lost in dollars, divide your outcome by your risk to get your R multiple for every single trade. Do this for 50 trades and then plug it right into the expectancy formula we just learned. Facing the honest math of your trading is something so many beginners avoid because, let's be real, they're afraid of the answer. But doing this honest accounting is the only way to genuinely strip away the P&L illusion, find your true baseline, and aggressively improve your edge.
So, I leave you with this question. When you open your charts tomorrow, Are you going to keep chasing the illusion of raw dollars, or are you ready to finally measure your true edge in R? If you want the complete system I use, including templates and calculators, check out the Funded Trader Blueprint linked in description.